Welcome to the Rodcast with Rod Turner, the show all about real estate. We discuss everything that affects asset-backed businesses, investments, and go deep into the details with some of the best in the business.
Hello everyone and welcome to another episode of the Rodcast. Today I've got a fabulous guest back in the studio. The last time we met I think was episode 72. It is Michael Kovacs from Castleforge, who had a fantastic interview last time. We were actually doing it on Zoom because I think we'd just come out of COVID. And he's got a business which operates in offices, residential, hotels, a little bit on data centers. So I was really keen to get you back here and find out what you've been up to for the last couple of years since we spoke. So, Michael, thanks so much for coming here and welcome. And tell us what's been going on.
Thanks for having me. Yeah, you're right. We're in the studio,
Exactly.
right across from each other, not over Zoom. And I think that's the biggest change probably that I'd say that we've seen over the last couple of years is almost a return to pretty much normalcy across the ways that we work, and that's been showing up a lot in our portfolio in terms of the office side. So we do have a serviced office business called Clockwise. It operates in 14 locations in the UK and 4 in continental Europe. And when we were speaking last time, when everybody was at home, obviously occupancy was pretty challenged. Now it's on its way to stabilized levels, 80-90% occupancy, which is normalized for that business, and at rates that are surprising us. And I think what it reflects is the fact that people are back in the office, people are back at work, seeing each other. In Europe, at least, it's very different everywhere. I mean, I've spent the last 2 years as well raising capital for our previous funds, and I go to Europe and Asia and the Middle East and the U.S., North America, South America, and the U.S. and North America generally is the one standout. It is a place where people are still working from home in a material way. The rest of the world is, I don't usually get to wear a suit. I have to break it out for the trips to Asia and the Middle East. People are in the office 5 days a week in a suit. So
and why do you think that's different across those kind of locations? What is it that's making it? Is it just purely a culture thing? Is it?
Yeah, it could be. I'm sure that's part of it. I'm American. You can tell from my accent. I think people just have bigger houses in the U.S., got a lot more space. Contrast that with a flat in Hong Kong or Tokyo.
Yeah,
you wouldn't necessarily want to be in it for 5 days a week with your other family members. So I think that it's a combination of a lot of things, but that's not necessarily going to change just because of technology. I don't think you can make somebody's 400 square foot flat in Hong Kong feel bigger just because of technology. So I don't necessarily think that means that people don't go into the office in those places, or that Asia lags the US. I think it's just structurally different.
Absolutely. And in terms of kind of what you're seeing on your office portfolio, what we spoke a little bit before we started kind of recording about the changes in sort of traditional leases for an office space, so versus kind of flexible working and co-working. What are you seeing has been the changes over the last couple of years in terms of those? Yeah,
I think that probably for the last, let's call it 2 years, the first 18 months of those 2 years was very slow on the traditional side. So bigger units, bigger spaces were sticking a bit, and they weren't leasing up as fast as we had previously experienced. I think that's changed in the last 6 months. Something happened at the start of this year where space that we were having difficulty shifting over the previous 18 months suddenly was all leasing. We talked about, I don't know what it is. I think to your point earlier, it could have something to do with the fact that people just realize this is the new normal. So let's get on with it and actually run our business. But that is certainly something that's changed. On the flexible side, we have seen over the last 2 years, just that business go from strength to strength. I think that more and more people are looking at flexible as a first option. mean, if you're sub 2, 3, 4,000 square feet, why would you fit your own space out if you don't do that for a living? And even if you do that for a living, you might not want to actually fit your own space out. That's probably the biggest change that I've seen over the last couple of years, is that more businesses at larger sizes are actually looking at flexible offices as a primary option, rather than as a, okay, well, this isn't plan B or an alternative to what I would normally be looking for.
And what are you seeing in terms of the regions versus kind of city centre? Like, obviously London is probably its own market.
Yep.
But how is that market differing across the UK then, would you say?
I think London's actually been pretty weak as a market. Speaking to operators who operate in London, we don't operate in central London. I think that there was a lot of competition that was, like WeWork, right? Hanging on to some of these leases, giving away deals that made no sense. And then it was forcing all the other operators into that same position. The regions have been pretty much insulated from that. And as a result, I think you have a lot more pricing power as an owner in a regional market. And I don't mean, okay, if I'm talking about Bristol, I'm not talking about Aztec West Business Park. I'm not talking about something, not actually in Bristol city center, right? Our building is in Bristol city center. Mm-hmm. So it's where people who want to work in Bristol want to go to every day, because it's such a great building with so much around it. And I could say the same thing about every single one of our buildings in the other cities. I was just up in Manchester on Tuesday, and our building is just off Portland Street. Over in Glasgow, we're on Sauchiehall Hall Street. In Leeds, it's Greek Street, right? So it's just the city center, right? And those buildings have been doing phenomenally well because they are at the core of what that market wants. It's not like if you live in Bristol. Some people live in Bristol and commute to London, but the reality is most people who live around the Bristol area actually work in Bristol. Yeah. And if they do, this is where they want to work.
And how do you think the commute affects that? Because I was a kind of big believer, especially kind of when the fallout from COVID said, that actually I wanted to get into London. I wanted to get into the office. What I didn't want to do was start my way in what's possibly the worst way to start a day, which is getting on the tube at rush hour. So how is that? Do you think that's an effect that has affected things? And is it London only? I know, like, commuting in like other cities, you've still got similar problems, but I just never see it as quite as bad as London, to be honest.
No, that's true. Listen, I've lived in London the last 20 years, so I can't speak to commuting in Belfast or something where we also have an office building. I'm sure the commute's better. I'm sure the parking situation is better. So it's probably not as much of a pain point. In London, that has definitely been one of the, I think the biggest changes that I've seen in offices in the last 20 years is almost a return to the preference for offices that are next to or adjacent to a major commuting hub. We're in Waterloo right now. I wouldn't have told you that Waterloo was a market that should have, say, outperformed Clerkenwell, in the last 10, 15 years. But if I think about the number of people who come into Waterloo and don't want to then go on another 20-minute journey once they get into Waterloo, right? There's beautiful buildings in Clerkenwell. Like Rosebery Avenue is an absolutely beautiful location, but it's 15 minutes away from any other station, right? And so I think a lot of people from a commute perspective are saying, you know what, I know historically maybe London Bridge or Waterloo was a lower rent location than some of the maybe more midtown or central locations, but actually it's not even anywhere near my commute in. Yeah. And so so Waterloo and London Bridge are, and therefore actually I think some of the highest rents are going to be paid around Liverpool Street Station, Paddington, King's Cross, Waterloo, London Bridge, Victoria, and that would not have been the case 10 years ago. And I think that that's probably, from a commute perspective, that's one of the biggest things that I'm seeing. And I'm even seeing it internationally, right? So we have an office in New York. We have somebody who lives in the suburbs of New York, Westchester, and she commutes in to where she commuted to Grand Central in New York, Midtown, and her first question to me was, "Can we have an office basically right above Grand Central?" And that would not have been the premier office destination 5-10 years ago, but now it is.
And I guess that's linked to the residential market because it's showing where people are kind of moving out from the centre, but still, I mean, I can't remember what the stat was. It's something like the average commute in London is 46 minutes. But then you can go, I don't know, 30 miles away. You can be in Kent on the coast and you commute still 46 minutes into Waterloo, King's Cross, wherever it's going to be. That's a really
good point. Right. That's a good point because it's really only a couple more stops on the train.
Yeah.
But what you don't want to do is then at Waterloo have to change and then spend another 20 minutes on a bus trying to get somewhere.
Mm-hmm.
Right. So I think that's going to be a big change for London. And all the corporates that we're talking to, we bought Deutsche Bank's headquarters last year, Winchester House. That's basically on top of Liverpool Street Station. I mean, it's 100 yards from the Elizabeth Line exit there. And all the corporates we're talking to is like, I just want to be right there. I want to be where people come into the station and walk 1 or 2 minutes, and that's it.
And how are you finding the difference in fit outs of office is attracting customers? Because we've heard a lot about energy efficiency. You've got kind of these AAA rated covenants like Google and what have you want a specific type of spec. Mm-hmm. How does that filter down into flexible spaces, and what is it that you're finding the market desires, I guess?
I think it's really bifurcated. So you have Google will probably have their own head of property they'll have probably multiple heads of property, right? Who are very, very technically capable in terms of understanding what the specification of a building means. I think when you're talking about a 4-person business in Leeds that's an accounting business, that they're just like, does the air conditioning work or not? And can I turn the air conditioning up and down?
Yeah.
Right. And so it's not that they're less sophisticated generally. It just means that they don't have the same standards necessarily as the corporates do. I think when you are trying to attract the big corporate tenants, and I mean like the largest Fortune 500 types of tenants, you do need to be aware that these groups are going to be more demanding in terms of what they want. And they do have a very, very narrow idea of what kind of building that they want. Mm-hmm. That's why we think that the high quality office, the sort of best of the best, not only the best location, but also the best types of floor plates, the best configuration for these large corporates are going to do phenomenally well because actually there's not a lot of them. And if you specify it in a way that they want, they're going to pay a lot of money for it. So, HSBC moved from the Wharf into St. Paul's, and they're paying high 90s per foot, or about 90 pounds a foot, which, for the city has never been done before. And then the recent news is Citadel just took a large pre-lease over British Land Space. That's at nearly 3 digits, right? 100 pounds a foot. 100 pounds a foot for the city, blended, not on best.
Yeah.
That is, but, when you think about it, for Citadel, that's probably not a lot of money relative to what their staff costs are, right? So they have the money to spend. We've done an analysis where corporates have never had more money to spend on their property because it's never been as low as a percentage of their total employee costs. So therefore, if I'm going to fight for talent, I'm going to get the best building possible. And that's driving rents. And we are seeing very, very fast rental growth, probably 20 to 30% higher than where it was pre-COVID.
Wow.
Okay, so that's one end of the spectrum. And then on the flex side, I think people are just wanting an experience and wanting a really good quality building where, like I said, does the air conditioning work, right? I don't need to know how many liters per minute or whatever I'm getting, but I got to feel good.
Yeah.
And does the general manager there know my name? Does the barista at the coffee shop remember what drink I like? It's a very, very daily hospitality-focused business. And the two are completely different, and they can be very successful financially, right? From a cash flow perspective and a security of income perspective, if you do both of them well. And then there's this broad middle of like buildings that don't really fit the corporate but then aren't really set up for flexible offices, I think they're going to struggle.
I think the key there was hospitality, isn't it? And that's really what that sector's kind of become. And actually, lots of other sectors I'm sure we'll go into.
Sure.
One of the things that resonated a lot with me from our last discussion was you gave a piece of advice to people who were coming into real estate investment,
Okay.
saying, and you said a great thing that stuck with me, which was, if you want experience, join a REIT, because you get buy side, you get sell side, you get a bit of asset management experience. And one of the things that I think Castleforge does really, really well is their analysis and the research that goes into it. What did you look at that made you think, right, this is a market we want to be in terms of the office space?
In flexible offices. Yeah, I think we kind of, it's a combination of top down and bottom up. So bottom up, we sort of fell into it. We realized that if we cut up some of the space in some of our buildings, they were leasing better. And so we thought, wow, there's something here. And we started off quite slowly. And then, one building turned into 3, turned into 5, and then COVID happened. But we kept going, and now we're at 18, and it's going well. So there was an element of, you're sort of pushing on an open door. You feel the door open, so you just keep going through it. On the other hand, it is top down. It is very much what's going on in the world, what's going on in terms of trends in offices. That's going to, why is this door open, right? Why is it so easy to push through? And I think that one of the analysis that we did was around income. I guess we did it last year, summer 2023, and it's a paper called "Only the Paranoid Office Investors Survive." A bit of a riff on a title of a book in a completely different industry, but the premise is what you should care about as a REIT investor is sustainability of income, right? You should care about a dividend. That's why you're investing in real estate to begin with. You get a dividend, but then you also get capital value growth over time. And so what you need to be focused on or concerned about is the ability of a certain type of real estate investment or asset to produce that dividend or cash flow without needing a huge amount of reinvestment capex over time. Or if it is, at least it's baked into the price.
Yeah, it's a blended price over time.
Yeah, that's
right.
right.
And the time, that's why we look at IRRs and we look at total returns over time and things like that.
That's right. And taking into account things like vacancy, things like releasing space, life cycle replacement of MEP, that sort of stuff. And hotels have always done that, right? Hotels always have a certain amount of vacancy. You don't assume it's 100% occupied. You have an operating cost. You have fees that come out in order to actually run the hotel, management fees. And so they always give like a really great picture at the end of the year, especially after they take out FF&E reserves, because they need to be refreshed every 5 to 10 years, of what your actual cash flow is. And offices never did that. Offices always were, it produces $1 million a year. It's like, well, yeah, but actually 20% of it's empty at any given time because tenants are moving in and out. You're always spending another $200,000 or whatever to like fit out space for a tenant or give them a TI package or a rent free. So it's like, well, how much cash am I actually receiving from this thing? And it never turned out to be $1 million, right? So anyhow, we wrote in that paper that where the office investors I think are going to be successful are the ones that are focused on the parts of the market where that cash flow is as close to the actual cash flow you receive.
So the net.
The net is as close to the stated cash flow as you can get. And I look at somebody like, if you talk about the REIT market, I look at somebody like GPE and I think, okay, these guys have a great strategy of we're going to focus on 2 parts of the market. They even say this in their annual reports and everything. And it's going to be the headquarters offices, right? So you're going to lease space to Google. They're going to take it for 20 years. You're going to kind of forget about it and collect 4 rent checks a year. Fine. That's actually your true net. And then they're going to take a portion of their portfolio and turn it into flex. And they're going to value that off the cash flow that they receive. And what they're doing is they're selling everything in the middle because they don't want to play in that space. They don't want their 5%, cap rate that their valuers value them off of to actually be 3% or 2%. What they want is that 5% to be 4.5, right? As close to 5 as possible. Yeah. So I think that what got us into the flex space was, hey, this is working, but also, hey, look, there's probably a long-term trend here where for the last 20 years, the actual cash flow, the net that you've been getting, because tenants have taken shorter and shorter leases over the last 20 years, is getting worse and worse. And nobody's recognizing that it's getting worse and worse. It's a bit of a frog boiling in a pot, right? And then you just realize, oh my gosh, this is a terrible cash flow stream, right? And so I think that if you want to continue to be an office investor, you basically have to focus on the real net cash flow. And where I think that the net closest approximates, gross is those two ends of the market.
That's interesting because people might be listening to this and thinking, right, just making that assumption, which I guess is probably quite true as well, in the flex space, because of the fact that it's got shorter lease lengths and things like that, means that it's a lot more work. It's a lot more operationally intensive and that kind of thing. And with any investment, you're looking at kind of reward versus the risk, but also the effort as well. And so the focus on, in terms of kind of having really good operators is probably, am I right in saying that's even more important than it kind of was, like you say, if you've got a Google renting your office for 20 years, it's set and forget kind of thing. Right. Whereas if you've got these types of leases that are much shorter term, you've got to be kind of on the finger on the pulse 24/7 really, because there's a lot more turnover and that kind of thing.
Sure. I mean, and that's that's something that you see in the hotel market.
Yeah.
Right? You would never value a hotel and not remove the management fees from the hotel operator, because it's like, well, yeah, but you couldn't run it without that, right? So similar to offices, we have running this 18 buildings, we have 100 people, and they do a great job, but that's a business and it's complicated, and you have to take into account those costs, which is why I never understood in the REIT market. Oftentimes on the office side, you'll have, here was my NOI, or here's my income, here's kind of my property level expenses, and that's my NOI, or that's my net rental income that I'm going to capitalize, and I'm going to say that's worth like a 4 cap. And then you see below it this SG&A line, and you're like, what's that? and it's sometimes it's 20% of the rental income, and you're like, oh well, that's that's our COO and CEO, and that's our property people, and it's like, well, how do you run it without that?
Oh yeah, I have this argument with people on a constant basis. It's a bit like kind of when you have a building and you go, right, I've got a long lease, I'm going to rent it there and that's done.
Yep.
And I kind of say, well, you're only as good as the operator, because actually they need to be sustainably making profit so that they can pay rent. So you do need to have an eye on what that industry is doing, what that specific business is doing, and how they're able to do it, because that is what determines market rent. They've got to be operating.
That's the difficulty of an industry that's changing. Is that you always did something one way. The leases were long enough that you didn't need to think about operations. Then the leases get shorter and shorter and shorter. You do have to think about operations, but the way that people are valuing it or thinking about the industry is the old way, right? And so that's what's happening with the office market. It's changing. By the way, same thing happening with the retail market. Shopping centers.
Yeah.
They're becoming very operationally intensive. They had been for so long, but nobody had been taking that into account. And now they are, right? And so actually those cash flows that you're getting are probably more indicative of what the long-term...
But that's leisure in general, which has always been,
100%.
Where is a family going to spend their Saturday afternoon when it's raining, kind of thing?
I mean, I grew up in Florida, right? And I can tell you in August, all you did was go to the mall.
Yeah, exactly.
It was hot.
Yeah.
I mean, I just got back from the Middle East. And by the way, what do you do in the Middle East in August, or in Japan in August, where it's brutally hot in the summer? You go to the shopping mall.
Yeah.
And that's what we were doing. And my wife, my son, and I, we went to, we were in Oman a couple months ago. And I was like, what do we do today? I was like, I don't know. let's go to the shopping mall.
Exactly. It's so true. And we have some leisure sites as well. And it's the opposite here. When it's raining, we do fantastic. But the summer, it's almost like, don't even bother trying, because when the sun's up, people do not want to be in here in the UK.
Yep.
And it's kind of, don't throw good money after bad trying to entice them, because they're not going to do it.
We're seeing that in our hotel portfolio. Some of the better months are the rainier months in the food and beverage P&L. Yeah, you're right. Yeah. Absolutely.
So let's talk about the hotel portfolio. Sure. I mean, we've gone through the offices. So run us through what your hotel portfolio looks like, where it is, the types of kind of hotels you're in, and why you chose to invest in those.
Sure. So we never, when we started the business in 2010 and really predominantly focused on offices. The second asset class we added was residential in 2017, but we always liked the hotel market, and it was something that I had done in a previous life. So, but we were kind of waiting for the right entry point. And I mean, COVID was obviously not expected or anything that anybody could predict, but we said to ourselves, this doesn't seem like it's going to last forever. But hotels are really challenged right now. So maybe it is the right entry point for us to get into hotels. So we got into the hotel market during COVID. With probably similar kind of bottom up and top down analysis. Top down was, hey, the global middle class is growing tremendously. There's going to be, I think we did this analysis where it was like there's 100 million people more per decade around the world that make between $40,000 and $80,000 per year. That means that at that level you can probably travel internationally. Yeah, you're not necessarily staying at the Ritz, but you want a good quality hotel in a tourist-based city. So then COVID came along, and we said, okay, well, let's make lemonade out of lemons. And we bought 2 hotels in Edinburgh pretty quickly. We bought one in Cardiff over by the rugby stadium, and then we ended up buying one in Bath. And over the course of maybe a year. And all of these were situations where somebody maybe it was like a family hotel. They didn't want to continue to invest in it, especially when they didn't really know when reopening would happen. Mm-hmm. We had a little bit more staying power. We said, well, let's fix the capital structure. There's ultimately nothing wrong with these assets. And they weren't, they weren't the Four Seasons, right? They were 3-star plus type assets that was targeted at the international traveler coming to Edinburgh who wants a great quality building in a great location, but doesn't want to pay through the roof for it. Yeah. Right. And so those 4 have worked out, phenomenally well. Right. I mean, we've seen rate growth in all of these markets. We've done some analysis historically where hotels have actually been the asset class that keeps up best with inflation. And listen, if you've been to a hotel lately, you'll probably know that is the case. I mean, it just feels like hotels just re-rated, right? And people used to pay £100 a night for a hotel in Edinburgh or whatever it is, and 150 is the new 100 or 200 is the new 100. And people are just kind of getting on with it. I don't know what happened. I don't know if that comes back, but I can tell you we travel a lot for work, both in the UK, Europe, and then internationally. And across the board, hotel rate is up 50 to 100% relative to where it was probably 5 to 10 years ago. And so anyhow, so that's doing pretty well. And, we want to do more, I think, and along the same strategy lines.
And what do you look for? So you've kind of gone through location type and the type of, I guess, spec and level that it is. What about size? So what is it you're looking for? Is there a kind of economy of scale? Is there a point at which actually there's too fewer rooms, or maybe is there a sweet spot if you're looking at 100 rooms or 20 rooms or 10 rooms? What is it there that you look for?
I think so. And I think that it depends. It depends on where you are. So if you're in London and the rate is very high, you can deal with fewer rooms. Mm-hmm. As you go into outside of London, Paris kind of locations, then, you start to get to a lower rate and therefore you need more rooms. Our hotels probably have on average 100 to 150 rooms, which is enough for scale. But we like that. We like that because then you're not trying to sell too many rooms. when you try to sell too many, you're going to end up with what we don't like are markets that have kind of rate ceilings or inability to compress. What I mean by that is hotel compression is like there are certain times throughout the year where the volatility of demand is so high that you can actually charge quite a lot. Mm-hmm. So Cardiff, you might think, well, wow, are there lots of tourists coming to Cardiff? Not necessarily, but actually there's a lot of people coming to watch rugby.
Yeah.
Right? And so at those times, obviously hotel rate goes up pretty considerably. So if you actually look across the year, Cardiff will have a better rate on average than Manchester, right? Even
because it's blended and it's just these peak times.
That's really exactly right. Yeah. So you have the same thing with Edinburgh. You have the same thing with Bath. And so those are the markets that we'd like to look at.
And when you were doing that analysis, did anything kind of factor in terms of what we've seen kind of in the last few years with holiday lets in terms of kind of the Airbnb market and this and the new legislation that's now come out kind of talking about putting a cap on that, I guess, and changing use classes, which is obviously very good for a business like yours.
We didn't sort of expect it to happen or anything. That didn't factor into our thinking, but obviously it is now. I mean, one of the biggest changes is every time I go to New York to see some of our investors, the pricing on hotels has gone up considerably. And I asked I have got some friends who are in the hotel space there, and they're like, yeah, I mean, think about it. It's like 5 or 10% of shadow supply just came off the market, right? Which is a huge, huge change to a finely balanced market. And so as a result, you have a lot of hotels that are doing really well in New York. If the same thing happens around the world, then you should expect hotels to do pretty well. And by the way, I have sympathy for Airbnb owners, right? I mean, the rules were such that you could then create a business around it, or you maybe you really do actually have this apartment that you live in 9 months out of the year, and like, what do I do with it for 3 months out of the year? But I mean, the reality is that it was skirting planning rules, right, or use class. If the local authority, with whatever it was, wherever in the world it was, wanted more hotel rooms, it would then zone for more hotel rooms, right? So I mean, there was this kind of regulatory arbitrage that was actually pretty unfair and against what the general planning authority wanted, right? I mean, you might say, well, the market wanted it, right? Okay, fine. Well, then go to your local authority and then petition for more hotel rooms to be zoned.
You're making an assumption there that local authorities are logical. It's good. Yeah. I mean, I guess you get places like Cornwall, for example, which had all these kind of second homes, and people were getting priced out because they couldn't live 100%. There, and things like that. You just think, well, just create more hotels. That fixes the problem, because the tourist industry is a big industry.
No, I think that's,
and you just think it's crazy that they.
No, I think that's right. I think that's right, and and then you kind of wonder, why is there a shortage of housing supply? So I'm totally behind the removal of Airbnb.
Yeah, I think it's a sensible way of doing things.
Yeah, I don't think that people were who are renting stuff out on Airbnb were bad people.
No,
it's like, well, that was the rule, so go for
it. You play according to the rules.
Totally
of the
fine,
game,
totally fine. So I'm not making a value judgment on it. What I am saying, though, is if the local authority is having problems with their housing supply, well, there's a reason behind that. So change the rules.
And let's get on to housing then. So in terms of residential, what have you guys at Castleforge been up to then the last few years?
So, last 6 years, we've been running a business called Ocasa. So when we met a couple of years ago, it was probably 3-4 years in the making, and now it's obviously progressed further. And that is a business that is focused on the lower to middle market residential.
So more affordable space.
Yeah, more affordable space. So I think that, excuse me. Yeah, we're focused on more of the affordable space. So whereas the new kind of BTR, build to rent, that a lot of people are talking about, around the country. We ran this analysis recently where we kind of said, look, even if you paid zero land value, given how much it costs to build, even outside of London, right, per square foot, if you then say, well, this is my return that I need per square foot, what does that mean for what a 500 square foot one bedroom apartment is to rent at? And it's like 12, 13, 1400 a month. And you think, okay, but in this market, like how many people actually can afford that if they're paying 30, 40% of their after tax on rent? And yeah, what we found, it was like the top 20% of the market. That's it.
But it's so difficult, like from a developer's hat on here, like you said, there's always going to be that cost of building. So one of the things that we found really great was when we could find a building that's already there and existing, and the rebuild value might be, I don't know, 10 million quid, and you're buying it for 2 million.
Yep.
You know that's barrier to entry. No one's going to be building at something that's going to compete next door because you can't build for that.
No, you can't. So that's what we ended up doing. So we stitched together a 50 asset portfolio over the course of 6 years by buying one building per month, kind of on average. And each of the buildings had between 40 and 50 units on average. So we ended up piecing together this 2,000, 2,500 unit portfolio that we manage ourselves. So again, the management team's up in Manchester. I think there's probably 80 or 90 people on that team, and they run this portfolio. And the product is called Ocasa. And it does phenomenally well because the average rent across the portfolio is something like £700 a month.
Mm-hmm.
Right. And then again, if you run that same analysis that we did before, if you're talking 8,000 a year, like what is the percentage of the market that can afford £8,000 a year at 30 to 40% of their after-tax income? It turns out to be not the top 20%, but like the 80%.
80, yeah, I was going to say.
And so your addressable market is huge. And so what we've been seeing is that we'll buy an existing building. The first one we bought it next to the old hospital in Ipswich. It's the hospital in Ipswich, but it was the old staff accommodation. And we refurbished the flats and made them really attractive for people who worked at the hospital, or they worked at, I don't know, a nearby retail warehouse park or something, or they worked at the supermarket. And we've just seen phenomenal take up in that. Right. And
well, it's understandable why.
Yeah, sure.
And also, when you're looking at that level, what you've seen is wage growth really increase at the lower end of the kind of value chain. Yep. We've got things like minimum wage has gone up, I don't know what percentage, but a big percent compared to the rest of the market. So that's been a huge positive.
It has. So I was talking to a contractor yesterday, and he was saying that the guy at the gate is getting £200 a day, right? I mean, just to stand there and open and close the gate on a site. I mean, that's unbelievable, but that kind of goes into rent.
Exactly. And so you've got that is kind of the tailwind, I guess, for that market. But then on the other hand, you also have all your other costs that are going up for a household. So your staples of living, your energy, your food, your transport, and 100%. Things like that. And so there comes a point actually where affordability is squeezed, even though rents have gone up because all the other things have gone up as well.
Yep.
How are you kind of mitigating that? Or is it a case of, well, that addressable market is just so big at the moment that we're okay? There's going to be some.
I think it's the latter.
Yeah.
So it is so big that you ultimately, if your average tenant is, say, making 20%, if they're in the 20th percentile of income earners, so there's 80% of the country above them, and that goes up to 25% because things just become more expensive.
Yeah.
Right? And so therefore you end up having to go into a slightly higher income earning bracket. Then there is that addressable market just is very big, right? And you can continue to do that. I had a conversation with somebody last week who was in the BTR market in London, and they said it. I don't think that they knew
tough market now.
Well, see, it's been great for the last couple of years, but I don't think that maybe they understood what they were saying, but here's they were like, yeah, it's pretty amazing. We've seen the affluence of our average renter increase tremendously over the last couple of years, and therefore, they're a great credit, right, because they make more money. And I was like, yeah, but okay, like how much more rental growth are you going to expect? Because if you went from somebody who's making in the top 20%, right, to the top 10%, how much more can you go before it hits the top of affordability? I was kind of saying, if you were an entry-level graduate who used to be able to afford that, now it's the kind of the associate director level, right? And then, okay, well, are you telling me that now the managing director of the business is going to rent that one-bedroom flat? No. So you run out of runway of an addressable market entirely.
100%. So we're seeing this even in things like the HMO market in London, where our tenant type, I don't know, was typically post-grad student that was going into maybe more of a kind of blue-collar working. Now we've got kind of bankers and lawyers coming in and who are on sort of 50, 60 grand a year, and you're just thinking, this is crazy.
No, that's right.
This is like where... At some point,
but it does stop. It does stop because it's not going to be. So your bankers and lawyers,
it's not sustainable.
Sort of it's like it's your graduate first year analyst. That's fine.
Yeah.
But then when it becomes the BP, right, or the managing director, it's like they don't want that product. Right?
Well,
then what they want to do is actually leave London and go out to the suburbs and raise a family.
Well, I think what you're seeing in the student market, for example, is you've got a lot of PBSA being built that's actually nice and new, and that in certain places there's been such a huge amount of supply created. So now you've got these kind of, I don't know, student houses where, well, why would I live there when I can live in that nice new place? And actually there's so much supply that they've had to bring the rents down a bit. So yeah, of course I'm going to go there.
Yeah. I was talking to somebody about that the other day, and they were like, well, at some point you have to comp like what a one-bedroom flat in that market costs.
Yeah.
Right.
Yeah.
I mean, it's like, I don't know what sort of West Hampstead. It's a nice market. There's probably some PBSA there. And, in many cases, you're getting 600, 700, 800 pounds a week for some of these student units. And it's like, well, it's cheaper to live in a one-bedroom flat.
Exactly. Yeah. It's I just don't think that's a sustainable market to be in. But again, on like going back to kind of the residential and looking at that lower affordability bracket.
Yeah.
What about kind of operational costs? Because with Asag, you said, for example, you've got 100 odd staff working. Yep. Your operational costs start to become a bigger percentage of the rent roll.
It is.
When it's a lower rent.
Yes.
And so how are you factoring that in? I mean, before when we talked about offices and hotels, we're talking about kind of the net rent you're getting and things like that. How are you seeing that's changing?
It's just factored in, right? And you have to factor it in, and it is a larger percentage of the total.
But I guess what you're doing is when you're refurbing these buildings, that's giving you you're future proofing a lot of that stuff as well.
But it is operationally intensive,
sure.
Right? And so when we're looking at returns, we have to look at net income, right? It was always very surprising to me that people looked at gross rents as a yield. It's like, well, that's kind of irrelevant.
Exactly. It means nothing.
It means nothing. And if you own one flat on a buy-to-let, right, and you get a 6% yield, you're probably netting zero after you pay for everything.
Well,
right? So you have to look at your net.
I think another thing that I find crazy is when people look at the yield on year one. Or so if they're refurbing something, what are they going to get year one?
Right.
Because you're not buying this and going to sell it after a year. You're buying to hold and keep it. So you need to look at that ongoing kind of.
Right, exactly.
Yeah.
Like, nothing broke in the first year.
Yeah.
Great. Okay.
Yeah, exactly. We put a new roof on and maintenance or I don't know, they've got to fix a boiler. Oh, we don't really count that because that was a one-off. Well, no, that's what happens.
So I think, so there's, okay, you're raising a point that's across the entire industry, something that maybe to think about. So a lot of people are saying that real estate's becoming more operational. But the reality is that I'm not sure that all real estate owners want to be operational, right? And so, the thing that you then wonder is, do the operations split from ownership, either through a hotel management agreement, but the thing is you're still taking operational risk, but somebody else is doing it, or does like the sale leaseback market, you got the
propco opco.
That's what I was going to say.
Yeah.
Does that come back where people say, you know what, I actually don't want to run a residential platform. What I do want to do maybe is accept a lower return, but earn a 3 or 4% yield and then never think about it.
Well, it's going from what essentially is a private equity model to a fixed income model, and
back to a fixed income model, which it always was.
Exactly.
And so that's kind of my question. So everyone sort of is saying, well, real estate's becoming more operational. You need to become more operational, and maybe the counter argument to that is, well, that's not what real estate owners want. And so does it actually move more towards a propco opco again as a way to counteract that? I guess what I'm saying is I don't accept necessarily the argument that real estate has to be operational for everybody, because it may not be what they want.
Well, it's a direct investment, isn't it? Rather than, look, let's just invest in a REIT or a public company if we want exposure to that. But if you don't, the whole point is you've got some sort of edge over the market. Otherwise, why bother?
Yeah. And Premierion's like a good example, right? That's something where I don't actually want to take the hotel risk. Now, COVID showed us that you are taking the hotel risk to some degree, right? When Premierion switches their leases off. But then that's why things like rent cover matter. I mean, COVID doesn't, let's assume that doesn't happen every cycle. Mm-hmm. But even in a bad cycle, if NOI falls by 50%, well, it's one thing if you have 2 times rent cover, and it's another if you have 1.3 times rent cover.
And I think this is why you're getting tired landlords, in inverted commas, kind of leave the market, because the last 20 years was easy. Yeah. And actually things have now changed. And it's not like, it's just a different time and temperament of some of these people. They're 20 years older. Yeah. They might have different needs and different wants and different kind of levels of energy and skills to put into something. So
we're seeing that across residential markets, hotel markets, office markets, anything where it's becoming more operationally intensive.
And regulation means that it becomes more operationally intensive too, as well. True. And that's a big factor, I think, in residential as well.
It's a huge factor in residential. We spend a lot of our time making sure that we're compliant from a regulatory perspective. But also, exactly, on the office market, right? People who bought, a 30,000 square foot, 40,000 square foot City of London office building across 7 floors, 3,000, 4,000, 5,000 square feet per floor, or whatever it was, and leased it out to 7 tenants and kind of collected everybody's rent check 4 times a year, are realizing that this is not the business that I signed up for, right? I didn't want to run a business. Yeah. And now it's a business. And so I think that we are seeing that across all sectors, as you say, sort of tired landlords just saying, I don't even want to do this anymore. Which actually makes sense. They should just go buy shares in a REIT.
Yes, yeah. I don't know why they don't. Most people we speak to is, well, what's your edge? And if you don't have one, why bother?
I was talking to somebody at GP the other day. I was on a panel, I think, and someone at GP was sitting next to me, and someone was asking me about, what is the landlord to do, right? And I said, well, actually, you should sell your building and buy shares in your company. Yeah, right. That's what you should do. You should do that. And residential, you should have always done that. Yeah. Buy-to-let has been there's been a lot of reasons that's been propped up. But truthfully, in the U.S., you just buy shares in a equity residential or whatever it is. So I think a lot of people need to reassess, do I want to do this? Or do I just want to own shares in a REIT?
I think that is such a massive point, because people get into this and think that this is investment and it's kind of, right, putting money in, I just sit back and wait for the return. Yep. And it is not the case. This is, like we talked about hospitality, but there is a massive element of hospitality in anything you're doing, because you're providing a premises. Yep. So whether that's for a corporate body or whether it's for an individual, you're still providing that. That's right. And therefore there's a need, and there's expectations and things like that. So it is tough.
That's right. Tough, and there's benefits of scale.
Yeah.
So if you're not
go big or go home kind of thing. Like, There's no point in owning 2 buy-to-lets because it's going to be much harder. Either scale up and get 100, or just
go by Granger.
Yeah, exactly.
Seriously.
Yeah,
that's what you should do.
Yeah, absolutely. I couldn't agree more. Brilliant. So, office, hotels, resi. Anything else that you guys have been up to?
We've been looking at data centers lately, as I'm sure the rest of the market has. But we've written a bunch of papers on the future of data centers, and one of the papers that we're writing now that we're kind of exploring is kind of the future of energy, really, and how we've gone from this period of kind of abundance of energy or surplus of energy. When you think about fossil fuels, right? It's not a sustainable use of energy for sure, but I think for a large part of the 20th century, we thought it was a sustainable use of energy. Turns out it's not, and therefore it's not as abundant as we actually think it is. Therefore, energy is going to be in shortage, in short, going forward. So if you think about that, and then you overlay the need for data centers, which are huge consumers of energy, in order to run all the things that we're doing right now,
sure.
Well, then wait a second, something doesn't make sense. So it's like you have an insatiable demand for more data. AI is just compounding that, and then you have a shortage of the kind of the fundamental input that makes a data center run, energy. That to me seems like a recipe for you should be scrambling for power. Right? And so I think that we're looking at data centers in that context. It's not just demand; it's also supply, because they're if you look at like the FLAP-D markets, right? 5 major data center markets around Europe. 2 of them, I think, have put like moratorium on data center build out, unless it's like unless you can link into a renewable source of power. But even getting yourself connected to the grid takes years.
Yeah.
And so there's a lot there in terms of supply constraint. And so I think we like those kinds of markets that are
getting squeezed from one end.
That's
so
right.
yeah.
That's right. So which is very much like a lot of the markets. I mean, the kind of low to mid market residential.
Yeah.
You've got the supply constraints naturally, but actually there's a lot of demand for it. Well, it's very similar in data centers.
And so, like, obviously, data centers is a fairly kind of, I want to say new, but it's growing. So it's not everyone's always thinking about it in terms of real estate, but it's clearly like a very fast growing kind of sector.
Yeah.
What is it you look for a building for a data center? Run us through that. What does it consist of in terms of like location and also the actual physical building?
I mean, there's lots of different types of data centers, so it depends on whether you're talking about an AI kind of enabled hyperscale type location where AI use is going to be the predominant use class, and in that case, maybe you want power, and then there's more connectivity related, latency dependent uses, and so you want to be edge or co-location facility that's kind of close to a population center. So I think it totally depends, but across all of them, you need power, access to power. You need access to land as well, actually, because you don't know what the configuration of the center is going to look like. So you kind of need to be able to be a little bit flexible in, do I build the center over less land because I have an AI use and it's 50 kilowatts per rack, or do I actually have more of a less dense need, and therefore I need kind of more land, right? So you kind of need access to land as well. And then you need people to be able to actually run the data center as well, right? You can't just put it in the middle of the field, in the middle of nowhere, because, well, who's gonna run it? Like, what technically capable people are going to run it? So you kind of need a combination of all of those. And then depending on what use class or use case you're running, it's kind of it's a variation on a theme. Right?
Interesting. Well, Mike, thanks so much for coming here again after kind of a couple of years.
So glad, and I'm glad we can meet in person.
And it's always great to chat to you. You've got super insightful things to say, and your research as well for Castleforge. We'll put a link in the show notes for that, but they do some absolutely fantastic research on different sectors and release really, really good papers. So
Thank you very much.
highly recommend that.
I'll let the research guys know.
Yeah, please do. And hopefully we'll get you back on again soon.
Good.
Cheers.
Thanks a lot, Rod.
Thank you.